up or still a bull run in US stocks, and that will stifle the bull era in commodities. It will stifle the bull era in gold and silver, right? The bull market in gold, it's there, it's fine. The bull market in silver is fine, it's there. But those crazy gains there, they're still on the table. That's why I think I did a tweet a while back. I said the true mind-boggling gains that people want, right? That they want to see their miners do 10x, 100x, whatever it is, 20x. They happen once gold is able.
Hey guys, welcome to Capital Cosm. Today we've got Patrick Karim back on the show from North Star Bat Charts. My good friend Patrick, how you doing, man?
Hey, Danny. It's crazy. We talked like, I don't know, for an hour about stats and seasonality. Like,
It's
we
like,
didn't even hit the record button.
crap, we forgot to record. Like that was a
But
podcast in and of itself, really.
yes, how does seasonality like scare you out of a trade? Like, how does seasonality impact change if you're in a bull era, right? All like if you take seasonality over 100 years, and then you know that October is usually a negative month, but you're in a bull market. So what are the chances of it being a negative month because the price is in a bull market, right? Or the inverse, or 2001 crash, and the SPX is supposed to go up in August, but you're in a bear market crash.
Yeah,
It's
but
like,
these are tendencies, right? It doesn't mean it has to happen all the time. But if you were to flip a coin over and over again, the chances are you'd get one result over the other by a smidge.
agree. So if you'd be really mechanical about it, and you just play the seasonality as a single system, then that's it, right? You just respect that. You should win over long periods of time, right? If you just play, if you get signals based on seasonality, but you dismiss everything else, like yeah, it's
Well, it's like you and Kevin always say, every when you make a conclusion, it's based on a confluence of evidence. It's just one piece of evidence to look at in the broader scope of things, right?
yes, yes, yes. But yes, and our job also is to, like I said just previously, to nuance it when that's to make that seasonality data more effective. It's like you have to break it down. When is it happening? Are you in a bear market? Are you in a bull market? And then that seasonality, you could probably fine tune it to extract more value out of it than just overlaying it and say, look, it's in October, oil's supposed to go down, then I'm going to short it, right? So yeah, I played around with it there, but it's another rabbit hole. And I said, oh goodness, it's like I just found it so I just rather focus on the actual price, because at the end of the day, also price that's in an uptrend is the aggregate of all the other evidence also, right? If you're above an inclining, whatever, 12-month moving average, it's everything else has to be aligned with that. And then the price just keeps going up until it doesn't. And then once you start closing below your moving averages, start losing important support lines, then no matter what the seasonality is telling you, no matter what the narrative is telling you, you have to bail, right? Because look, what's happening with gold now? Like, are we close to a top? Or we're all-time highs?
Mm-hmm.
What happens when you're at all-time highs for gold? Greed starts picking up, and then you start looking for narratives to say, there's a conflict in the Middle East. Gold's going to go even higher. You start looking for stuff to keep you in the trade, right? But there should be only one thing that keeps you in the trade: is the price doing higher highs and higher lows? Am I still above an incline moving average? That in itself, that's like classical stage analysis, Stan Weinstein style. Am I in an uptrend? And as long as you are, no matter what like the macro narratives are, then you're golden. But let's say war does break out in the Middle East and all these, I don't know, supposedly bullish events. Let's say the Fed starts printing money, but gold starts faltering. What are you going to do? You're going to say, oh, well, they're printing money. Gold has to price that in. Well,
But typically, when you have these sort of when you're betting on these sort of events, the reason why you can kind of see these in the charts to begin with is because you tend to have insiders play these trades
yes,
before everyone else does. So that's
yeah,
why you see it. That's why the charts are kind of upstream of everything, right? You don't need to bet on these events happening. You can kind of see them play out in the charts in real time by virtue of insiders.
yes, 100%. Exactly. Imagine that. Every time I do an interview or something, Danny, I always try to find a way, an analogy for this to crystallize in people's head. The price it's like you had a seat at the board table, at the board meeting table of that company that they just signed a new contract, that he tells his wife, that the secretary reads the notes, and she says, oh man, they're going to buy this thing, and then she leaks it out and more people buy, and the insiders start loading up. Man, you just have to observe the price, and you'll see all that stuff happening. It's crazy. And even better, you could wait for all these people to start positioning themselves over years at the bottoms, right? And then when the price really breaks out, when all these people decide to stop selling and keep buying, man, as a chart trader, it's beautiful. Just wait for that horizontal breakout line. And it's like you have a seat at the table. It's crazy the advantage it gives you once you truly understand that the actual price that you see is the aggregate. I don't know what other word I could put in there of every single market participant, discounting stuff in the future, short term, medium term, all that stuff there. It's there, right? Even manipulation. People love talking about, oh, it's China that sets the price of gold. I heard that recently. And so they set the price of gold. They're the only market participants in the entire planet. It's like, how do you properly know that China's buying the gold is actually that's moving the price, right? Is there somebody taking the opposite position? Like, how do you know about this stuff? It's like, I know I'll never know, but I do know the end result, right? China buying, Russia buying, America buying, Europe buying or selling, all that, these people buying at different moments, and makes up the price chart. And all I have to see is just wait until the price is starting to trend upwards. And that's how you make money. It's like, no disrespect to Warren Buffett. Okay, I won't name names of fundamental guys that never look at charts, but it's impossible for anybody to make money if they're not buying and the price is not in an uptrend. It's impossible. Let's say, forget about the shorts. Let's say you're just buying and hoping. If you're not in an uptrend, how can you make money? So I don't care who you are, what type of billionaire you are. Peter Lynch, don't care about charts. You mock them. You don't care. But no matter what your narrative is, if the price is not trending upwards, then you will never, never make money. Never. And it's super easy because you look at the chart, just look at the moving average. And if the price is above an inclining moving average, it's mathematical. It's the price is appreciating. You're making money from your entry point, right? It's like it just removes so much of the noise, so much of the energy of rambling around, and it's just so clear cut there.
What about the aspect of being a contrarian? Can you be a contrarian if you're just chasing momentum?
You're a contrarian to what? I know, like, I love being a contrarian. Everybody loves being a contrarian. Like, this thing is so disloved that, it's cheap. It can't get cheaper, like, I have to buy it. That's fine. Okay. It's good to be a contrarian. So at least from a psychological, you're going against a crowd, but the crowd could be wrong for a very long time. It's like, when do you know that your contrarian play is going to pay dirt, right? Let's say palladium's from 3,000 goes down to 2,500 to 2,000 to 1,750. Oh man, palladium's starting to get cheap historically, whatever. I'm going to start being contrarian, but then it goes down, 1,500, 1,250, 1,000, 900. It's like, how much? You got to have a game plan. So the only way for you to make money being a contrarian, price still has to revert upwards, right? It still has to revert upwards, because if price goes sideways for a year, 2 years, it hurts the soul. Like, your emotional profile, emotional capital, it gets destroyed. So be contrarian, spot whatever you think's cheap. That's fine, but please at least wait for the price to start turning upwards. Look, if your contrarian idea is that X is worth so much more, tenfold, it's the market there's an arbitrage play. It's not pricing it properly. Then trying to catch the exact bottom is kind of a fool's game, because that means you're getting greedy for the bottom move, whatever, 50%, 100% is going to do off the bottom, but your fundamental thesis is that it's going to do 10x. So who cares? Sacrifice 1x off the bottom. Sacrifice it. Let the market do a higher high and higher low, because you're going to trap the other 8x wherever it's going to do after, right? So if you really trust your fundamental thesis, there's no reason to front run the first bagger or the two baggers is going to do the bottom, right? Because you're going to trap the 4, 5, 6 bagger. You're going to catch those other baggers is going to do in in the meaty part, right? In the easy bull run era. So even by that notion, being on contrarian and front running a chart is such a dangerous game, such a dangerous game. It's trapped so many people, and I wish more people would speak out and admit, like, oh yeah, I DCA'd into this, it went sideways and down, I gave up at the bottom, then the price moved up. Like they could have just waited. There's like no reason to wait, and I hear that often, like, oh, by the time you get in, you realize the move's done. Well, that means you have a very weak fundamental thesis if you think that. Because if you think by the time it breaks out of a horizontal base, the move is done, that means your fundamental thesis was very weak. You never thought that it was that undervalued, right? But if you really think that like gold's going to go in the 10-year bull era or whatever, the miners are going to go in the 10-year bull era, then let the market prove to you that it's ready to enter that. And then you just wait for the horizontal breakout line, and there'll be a lot of juice left to squeeze, and you'll make your gains there in a higher probability fashion, right? That's like there's so many charts.
It's all about setting your expectations. It also comes down to that, doesn't it? When people try to time bottoms and things of that nature, you've got to set your expectations to be able to manage volatility. Maybe even another, I think I mentioned this to you before, but the road to a 99% haircut is a 90% haircut followed by another 90% haircut, right? But so you've got to be able to set expectations that you could, you may not have caught the bottom if you're trying to catch a falling knife.
Yes.
But is there a time frame that you have in mind? Are you willing to hold through 5 years, maybe more, in this stock to get these asymmetric gains that you're expecting? But yeah, it's all about risk management, not over leveraging yourself with this stuff. Your position sizing is another aspect of it. Don't go 100% in on some shitco or like something that's down 85% that could go down another 85% or something like that. Be responsible with this stuff. There's proper risk management that goes along. It comes with the territory. But definitely, one thing I like about you guys in North Star bat charts is that you do try to make this as scientific as possible. And I want to touch back on what you said about gold. So just to kind of be clear, do you still see a lot of juice left in the gold move?
Let's check it out then. Oh yeah, that's scary, right? Look at that. I drew a 12% drawdown for gold. Yikes.
All the way down to levels not seen since July.
Yes. Well, okay, I'll just so let's look at gold, because one of our members, he wanted to know, let's say gold does peak at 2600, and before it weighs down, and then after that, let's say there's always like, let's say a market crash, whatever, and gold could go down 25%. And this is what's super dangerous. You have to, when I put in targets, let's say gold's at 2000, and I say my target, let's say 2600. It's hard for your brain, if you don't look at charts all the time and haven't been used to charts, it's up and down, sideways, up and down. Like people imagine in their minds a straight line, and they imagine their portfolio going X percentage. It's like a first reflex you do. Oh, if gold goes to that price, my portfolio will be worth that much. But then you imagine it's a straight line, right? Or then if I tell you, well, let's say we reach 2600, and then I'm expecting, let's say, a 25% haircut on gold. And then people imagine a straight line down, right? Crash, like something crazy. But this is the daily chart for gold. Let's say we did reach 2660. And let's say I did say, like, at one point that, let's say we would get a 25% haircut. Goodness gracious, look at that. Look at that thing. 25, let's say 25%. Way before, it's not going to crash, guys. I'll show you even the 2008 crisis. It's not going to go there in one shot. What's going to happen here on the daily chart, you're going to start losing the 12 period moving average. You're going to start losing here. You're going to start losing, here's my blue line, the 12-day moving average. And then you'll start losing the 36-day moving average, right? You'll start losing these moving averages. The top is good, the momentum is going to slow down. You'll start carving out whatever top, you'll lose a rising trend line. You'll have a plethora of opportunities to exit. You could choose to exit here, right? If it falters, you'll be able to exit here on the retest if you wanted to. You could wait, depending on your time frame, you could wait. So even for a 12% haircut, never mind the 25% haircut, there will be many opportunities to exit on the daily chart when gold is 4 or 5% off its highs, depending on your time frame, right? You'll have a whole bunch of opportunities to exit, not at the peak. There's techniques we do have to try to get out the peak, but it's only in hindsight you'll ever figure out, right? You see here, I didn't enter the bottom here, right? I entered 3, 4, 5% up. I rolled this. So we never entered the bottom and you never entered the top. But before you're super scared of a full meltdown, I know I'm diverging. I'll just show you guys. It's important for people to manage fear. Here's even here, the 2020 meltdown. Gold was starting to losing momentum, closed below the 12 period moving average. Here, closed below again, the 12 period moving average. There's a whole bunch of places you could have bailed. You didn't have to go through all that, because if that thing would have cascaded down, because the price went up, it doesn't mean there wasn't a possibility of this going down, right? It's the unseen consequence or the unseen path, right? We always see in hindsight, oh, of course it went up. I should have bought the dip here. I'm sorry, but that could have, let's say they didn't save or they didn't print money. That, of course, that could have kept going down. Of course, it's a possibility. Was it a high probability? Well, until it started going back up a little bit, it's only once you regain those moving averages here, then that's the market telling you that you had a higher chance that this super scary scenario was off the table or more off the table, and that an uptrend was in place. But I'll show you 2008, guys. Let me zoom. Let's say people are always scared of the next 2008 crash. Well, look what happened in 2008 on the daily chart. Because look, before it falters on the monthly chart, before it falters on the weekly chart, it will always falter on the daily chart. But even if I didn't have a valid trend line, let me get my circles here. I lost the 12 period moving average, right? Remember, in an uptrend, you're always outperforming even the shortest of moving averages, right? You're trying to oscillate above it most of the time. Anytime you start losing moving average, it's slowing down momentum on that time frame. Even here, oops, let me draw. You're losing momentum here. Here you close below the 36-day moving average. So yes, it hurts the soul to see it go up to 1,000, and then the price goes down so much that it's forcing you to sell 12% below. But what it means is that's the insurance cost to avoid, where's my arrow? To avoid this possible scenario. Oh, goodness, it kept going down. That's the insurance cost. Yes, you didn't sell the peak, and people often they'll hold because they always hope, it goes back up. Often, if you're lucky, if you didn't sell a huge break, there is often a retest. But if the retest fails, that's like you see, you had a retest, even have two retests. That was of that breakdown line, well, that wall, the retest of the 36-day moving average once, twice. And after that, it was just in trouble. Even here, it tried to go back up, but it just faltered. Essentially, that was a sideways move that just cascaded down. But when I'm trying to tell you guys, before you have a 34% drawdown, it's not going to fall like that, right? It's just not, right? You'll have a whole bunch of opportunities here, even here. Let's say you did hold on through this mess here, and look, it failed again here. Here's my wall. All this, it's failing. So you'll have the charts will tell you way before you could avoid all this stuff and the time, opportunity costs. And then after that, it goes back up. So don't worry, guys. If you use charts, you will be able to avoid these huge 34% drawdowns. You will be able to avoid them, right? All you have to do is listen to the smaller time frames. So where's the target that's what everybody wants to know, right? Like, guys, why do you have a 1 hour podcast when in 5 minutes you could just tell me where it's going? I read that somewhere.
That's what they'll do. They'll be like, well, price targets at so-and-so minute.
Yes. So here's the monthly chart, guys, for gold. Reset chart. And it's doing a whole bunch of targets here. this was the base of June of 2019. I'm just going to zoom it in for your viewers. So there's a whole bunch of measured moves here that are starting to get reached. It depends where you start this thing. Was the continuation? It's like we're starting to get there. Remember, like we're stretched now because all bull eras. Once you have an important base breakout, all you have in bull eras, the classical TA patterns will be pull flags, pull pennants, pull flags, right? That's in the bull era. That's all you'll see here. It's just a sequence of 3, 4, 5, 6 months going up, then consolidation, 3, 4 months up, then consolidation, letting the moving averages catch up, right? And then you ride, look at that beautiful extension here. Then, you know what? That's all it is. That's all a bull era is, right? Pull flags all the time. Now I tell you, Danny, where's my flag now? I've been running hot. One, two. I've been running hot for a while, right? I used to have an indicator called, maybe I should put it there.
Well,
Let me
let me ask
check
you
it
a
out.
quick question. Let me ask you a quick question. So I'm looking at your candlestick. So you've got this hammer candlestick at the most recent. What is this? The 1 month. How much weight do you give candlestick patterns in something like this? So this would be like a continuation pattern to the upside, right? Because the buyers ended up overpowering the sellers in this case through that
Yep.
long wick at the very bottom.
Yes. Well, it's good. So as long it depends where that happens, but now it's happening above a 12-month moving average. So during the month it was super red, right? And people getting super scared. And now by the end of the month, it was all the way down here. That was a super red candle right here. And now
Mm-hmm.
it's all the way back here. So yes, like you said, the higher time frames buyers, because when you're on the monthly chart, you're letting time for those hedge funds to buy. They have 1 month. Whoever wants to buy, you're encompassing 1 month of buying power and selling, of course. But on the balance, more buyers are coming in right now, or the 19th of August, are coming in and overriding that. Because I could have put that on the daily chart, and you see, look, there's strong moves down that happen right during the month. When did the month start here? See, yeah, here, August 1st, it went down all the way down here, and you would have been panicking on the daily chart. But then after that, the buyers came in, and they're keeping coming in right now. So I am stretched. There's a pull flag. There's a flag now that could happen at any moment, right? It's going to be a 2 month flag, a 1 month flag. Maybe the flag is just going to be once we reach that target here, 2,700. So to give myself some clues, I look at the distance from the moving average. At the bottom pane is distance from 36-day moving average. And then I just stretch it historically. I'll just put it where we are here. I'm 28% above the 3-year moving average. So I know you love data. From a statistical probability for all these monthly closes, I don't know how many monthly closes we had since 1971, right? What, 50 times 12, right? We've had
600.
yeah, monthly closes since that period. Look how many are above. Most of them, the bulk of them, are below, right? So once we're stretched that much from the moving average, you're starting to enter in outlier territory, right? You're not in a territory where you should expect it to keep going up. You're in a territory where, okay, I'm not in an area in the 70s, like, it just busted here. I'm in an area right now that
It's
there's a
the
pot.
exception, not the rule.
Yes, right now we're starting to enter exception route. So that's step one into selling to strength. But you shouldn't, if you want, like, let's say you want to let your winners ride, right? Understanding that your stretch is step one. Step two is understanding when it's weak, starting to weaken, right? So this rising, I could even, the more acute it is, the more it'll give you a faster reaction time, right? The steeper an angle a trend line is, the more you're seeking data from the shorter time frame. So for me, let's say I'm on the monthly and I have a super steep rising trend line. Essentially, what I'm doing is I'm nitpicking. I'm zooming in on the smaller time frames, right? Because on the smaller time frames, I'll see that line falter. It'll look like a bigger pattern on the smaller time frames. But this is a pretty
And
aggressive rising trend.
why that's important is because your distance from moving average, although it seems like a linear slope up, the higher it goes, it actually means more divergence away from the moving average. So, as in the price diverges more and more away. So,
Yes.
yeah, you may be going up from you're at 28 now. You could go up to a 40. Um, it's not a linear move up in the corresponding price at the top panel. It's actually kind of an exponential move up because the gap between your moving average, which is moving up, and your price is growing even more.
Yes, because it's dragging everything up. So
Mm-hmm.
that's just the distance. But if you're moving on the log scale on the price, that's what's happening. The price is moving at logarithmically. Then the distance from moving average is not moving logarithmically, but it's still because the price is just going up logarithmically, and then then the moving average is just tracking that. But we're approaching FOMO territory. So I don't know how much there's left, like 2,700, a spike up to that, 2,600. Look, this is a crazy pull flag, huge base pull.
Well, what about the gold to silver ratio? The gold and silver ratio has been on a tear upward for about, I want to say, 3 months now or 2 months now. Is that your indication that the rally up is coming to an end?
Well, it's been going up, but now it's been selling hard. So this could be a simple back test. So the gold silver ratio is still pretty much going sideways for a very long time. Here's the COVID spike. It had a breakdown here. Now it's retesting. But like we talked before, like the moving averages, like if you want to be objective, I'll just hide the price here. Hide, 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 hide. Look at the moving averages. They're kind of, flat, still trending a little upwards. So there's no clear downtrend yet. You see here the GSR, the gold silver ratio plummeting here in the 2000s. Huge bull run for silver here, right? And gold. Here, reflating GFC after that's when silver went all the way up to $50. That's the top. And then that was the bull run for US equities. So it's still not the GSR is not out of the woods yet. So we could have a spike up. What does that mean? A market sell-off, silver's getting sold off more than gold, risk-off event,
What do you make of
DXY
this?
shooting up.
Yeah, what do you make of this gold price move? I mean, this pretty big jump we've seen in the last several months, all the way up to 25.50. But you look at the gold to silver ratio this year, and compared to what you saw in 2020, like that thing collapsed in 2020. That was when silver was outperforming gold, right? But
That's
silver
right.
hasn't. Gold has
No,
severely outperformed gold in this time around. Does this pretty much tell you that even though we've seen a pretty good move in the gold price, that it's not precipitated because of the fact that we're in a precious metals bull market? Really, could it be because of exogenous factors like what is it, crisis hedging or risk hedging from all these
yes.
crazy things going on? That's what it seems to tell me.
Yeah.
It's telling me that this is more of an artifact of external factors as opposed to a fundamental precious metals rally.
We're not, like I'm starting to like not educate people, but explaining people my terminology. So for me, I have the word bull market. So bull market is anything, let's say, price trending upwards. Like I'll just I'll answer your questions. So for bull market, this is a bull market. The price is inclining above a 12-month moving average, above a 36-month moving average. Then here it went sideways up. Bull market. That's a bull market. Gold is in a bull market. Higher highs, higher lows. A bull era is you're in an uptrend, but you're also. Let me put live charting. Where is it? Okay, here. And a bull era is you're also outperforming, minimize that. You're also outperforming SPX. You're outperforming another major asset class. So while gold is in a bull market, silver is in a bull market. They're both above their inclining moving averages. You're not in a bull era because you'll see bull eras for gold happen when it's able to outperform. That's a bull era. Because why that's important is because the plethora of miners, the aggregate. Of course, there's outperformers and there's outliers and all that. But the if I put, let's say, the ASA chart on this there, the gold and silver miners, which is the JDX, but with more data series. Just click and drag that here. Log scale. It tracks the ebbs and flows of the gold versus SPX. So here in the bottom pane, this is the gold to SPX. So you see the strongest gains in the miners is when the precious metals complex is in the bull era. You see how it just tracks those flows, right? Look at that. It's practically the same. So even if this, no matter what the miners did right now, the true mind-boggling gains happen when the precious metals complex is in a bull era. And it's coiling right now. It's getting close to it. Remove drawings. We're getting close, Danny, there. Remember, it's again, look at the moving average. That's the 36-month moving average of that racial chart. It is coiled. It is coiled and tight. So that market event we're talking about, the fact that the GSR also hasn't totally plummeted, right? Like it did in 2001 or 2009, 10 thereafter, it's telling us that it's possible that we're like here somewhere. We're waiting for a market roll off. We're waiting for really the markets to roll over. Then gold can outperform SPX and be in an uptrend versus SPX, thus defining the bull era for gold, silver, the miners, right? Or even other commodities, right? Like commodities will go bonkers right here. I could overlay the uranium chart here. I could overlay the oil chart. They track this a lot. And we're getting close to that, Danny. So it could be in the fact that the GSR isn't entering a bear era, right? In the precious metals bull era, you want the GSR to plummet, right? You want silver to outperform. It's giving you mixed signals that the coast is not 100% clear yet. It's just not. So your thoughts are substantiated by the charts that we're still at risk of a market sell-off. But to say that it's going to happen overnight, it's like, let me just look. We're still above. Look, where's before this thing falters? Remember, I showed you guys like on the daily chart, like this thing's still net trend. Like that's the SPX. There's no signs at all of any type of rollover, and you'll see it on the daily chart. Like let's say, like here it could have faltered, but it didn't falter. So what happened is that's a bullish expanding wedge that resolved upwards, and off it goes, right? Because before we have a 2000 type of crisis, a 2001. Let me zoom out. Let's scoot over here. Let's say 2008. We're not going to have a 50%, like the market's really plummeted. But you're going to start seeing it. You're going to start seeing, like, let me zoom in here. Sorry, guys, I don't want to give you whiplash. But you'll see weakness. You'll see then there's rallies. Then you'll see a falter again. And eventually one of these is the one that's going to really falter. So lost momentum, losing more momentum, not able to, maybe here it's trying to get back up. Then it falters again. These are not characteristics of an uptrend, right? So before you have, like, whatever, like people say, oh man, I lost everything here. Goodness, what was that drop here? Like before you even have a 50% drop, you'll have, 10% drop. Right. You'll have a 20% drop, and there's no reason to hold. You want to hold. Look, this is a healthy bull era, bull market run, right? Above the 12-month, or above the 12-day, above the 36-day, with no hiccups, no emotional, like even a fast 36-day moving average is able to make you to net some nice profits, right? So until that happens, so let's go all the way to today. Let's zoom. I could have just clicked a button there, right click, reset chart. So here we had a chance of this faltering. We lost momentum, fine. But it's not in a shorting, like this we'd have to re-lose again the 12-period moving average, the 36-day moving average. So before we have a market meltdown, a proper rollover, it's going to look a little bit like, I'll remove all my drawings here. like this is probably what a market top is going to look like. Let's say this was a market top. Let's say, I don't know, it goes up here, 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 that's 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 a higher confidence market top, this, right? So for something proper like that to happen, goodness, we could be in November before we have a proper market top, right? It's like it's not going to happen overnight, right? It's gonna, how it is. Money's still going to be sloshing in. The market price going down, but the people who still wanted to buy stuff, the hedge funds, the pension funds, they're buying orders. Like, there's still going to be some money, right, coming in, even when people are selling, right? They can't turn a dime and say, hey, we're selling this market. Like they're gonna have to do board meetings, whatever they have to do to decide before buying or selling. They might be slow, like these huge Titanic plethora amount of cash. It's going to take time for it to liquidate. So that's why it creates tops, right? That's where. But this is slowing momentum. Beautiful head and shoulders top possible, but it has this. You don't short here. You short all the way down here, right? That's a higher conviction top. I don't even know what you can look at. Look, even on the monthly, that's not even a top, a proper top. You see that the line I drew on the daily, it's just a correction on the monthly. So on the monthly, it's gonna look way like it's gonna take a lot of time there. Let me do a little draw some squiggles for you guys. So I'd say it does go up. I don't know, man. It could take. Goodness, is this possible? Like
Only until 2030.
2026, yeah, that's crazy. It's like a proper market rollover. Like everybody's like clickbait, the market, like, crash. It's that uptrend is so strong that before you start thinking, of course this could happen, Danny, and it goes down right here. But yeah, you can't front run that, right? It's a rising uptrend. There's higher chances that it tries for a crazy retest, right? To trap everybody. It's not going to fall in one day, this thing, you know? If it does, we'll see it. We'll be able to leave on the daily chart. But look at that. It could take a while before look. I'm going to go here. What happened here, though? Did it fall? Okay, it could happen faster. The 1 year moving average. Then after that, after we lost the 1 year, 5 months, and then so after we lose the 12-month moving average. After we lose a 12-month moving average here, it could take 1, 2, 3, retest. Then we lose the 36-month. But look, we're not even close to losing the 36-month. So maybe that is a little, I'll draw it maybe a little, lose a 12-month. 1, 2, 3. Okay, sure. A shorter, this would be a very aggressive.
Yeah, but that still goes all the way out to 2027 or
yeah,
2026.
Yeah, to start, really like falling apart there. Like here, I'll put it here. Let's say, like, we're next year, 2025. Yeah. So expecting this thing to do, you know how people like they align down here? That's a low probability event, right? It's more going to go sideways here. It's going to go down like this. And then you'll see. So there's these fear scenarios. They're not, and it explains why the SPX has still gone sideways versus gold, or gold versus where's my autofocus here? Gold hasn't broken out versus SPX. Maybe we're not having a market crash right now. Maybe there's still a melt up or still a bull run in US stocks, and that will stifle the bull era in commodities. It will stifle the bull era in gold and silver, right? The bull market in gold, it's there. It's fine. The bull market in silver is fine. It's there. But those crazy gains there, they're still on the table. That's why I think I did a tweet a while back. I said the true mind-boggling gains that people want, right? That they want to see their miners do 10x, 100x, whatever it is, 20x. They happen once gold is able to outperform SPX. And by the looks of it, we're just not there, Danny, yet. It's crazy. Like, I'm sorry, the doom guys, but it's going to take many, many months before the US stocks properly roll over. Many, many, many months, right? It's crazy.
Yeah. Well, I think this covers it for today, Patrick. We covered a whole host of things. But yeah, anything else you want to add before we wrap things up?
Guys, look, we cover this stuff all the time there at northstarbadcharts.com there. I don't want to plug too much there, the website there, but I think Danny usually has a link there if you guys want to join up with us. But go on Twitter, guys. Don't fall for fear scenarios. Always look at the chart. It'll tell you the truth. When the momentum's starting to slow down, we'll tell you. We'll see it. It's like before the monthly fails, the weekly will fail. Before the weekly fails, the daily will fail. There's no mystery like behind any of this, and never fall for fear scenarios. There, will you'll be able to see it come through the charts there, like 99% of the time.
Yeah, fantastic. Well, thank you so much for coming on, Patrick. If you want to see more of Patrick and his partner Kevin's work, be sure to click the link down below for the North Star Bat Charts website. They're one of my favorites, one of my favorite websites and analysts out there. So be sure to check them out. Like the video if you haven't, guys. Subscribe to the channel so we can keep getting guests like Patrick on. And just if you enjoy this content, and we are rolling out videos just about 5 to 6 times a week now. So it kind of behooves you not to subscribe. You might miss an episode. So be sure to hit that subscribe button if you don't mind. It's free and it really does go a long way in helping the channel grow. And yeah, let me know what you guys think. Comment down below and I'll catch you in the next episode. Bye, y'all.